there's obviously not a zero risk of something happening to push gold down. Oh, I think that would be at 4,000 at that point. Other things being equal.
Yeah.
But but the interesting thing is, it's not only, you're absolutely right, of course, but the dollar is the main short-term or near-term factor that tells you what the gold price is, obviously, the gold price in dollars, obviously. But it's not the only driver we've seen over the last year by any means. And we've had many periods when the dollar's up and gold is up as well. But clearly, if we see the Dixie down to 90, or I think it's going lower than that, gold will move up, gold will respond.
Commodity analysts who make long-term forecasts generally agree on one thing: gold is poised for a sustained rise in the coming decades. This projection is driven by a confluence of factors, most notably the increasing global demand for the precious metal and a strategic shift in how central banks manage their reserves. Over the past 25 years, the US dollar's dominance in global foreign exchange reserves has steadily eroded, falling from over 70% in 2000 to under 60% in 2025. In contrast, central banks have ramped up their gold purchases, clearly signaling a pivot toward hard assets and away from dollar-denominated holdings. Renowned financial analyst Adrian frames gold's ascent not simply as a reflection of its intrinsic strength, but rather as a response to the US dollar's declining purchasing power. He suggests that if the dollar index, a key measure of the dollar's value against a basket of major currencies, drops to 90, gold could realistically climb to $4,000 per ounce. For Day, the geopolitical unrest in Ukraine and the Middle East may support gold prices in the short term, but they are not the fundamental drivers. Instead, he emphasizes the more profound shift taking place. Global central banks continue to reduce their dollar exposure, with reserves now sitting at just 58%. Concerns over U.S. fiscal instability and the growing use of the dollar as a geopolitical tool are spurring this de-dollarization trend. The greenback's decline has been particularly sharp this year, especially in April, when uncertainty over U.S. policymaking triggered a significant sell-off. Since January, the dollar index has weakened by more than 8%. Despite the near-term risks, Adrian expresses near-total confidence, 99.5%, to be precise, that gold will end the year higher. His conviction rests on a critical issue: the looming U.S. funding crisis. As foreign buyers retreat from U.S. debt markets, hedge funds have moved in to fill the gap. Meanwhile, the Federal Reserve appears increasingly likely to return to quantitative easing as quantitative tightening nears its conclusion. According to the U.S. Government Accountability Office, America's debt is projected to grow at twice the rate of its economy over the next 30 years. In this environment, gold's appeal is magnified. It is an asset that thrives not just in times of risk and volatility, but also amid narratives of unsustainable debt, market overvaluation, political polarization, and the long-term decline of the dollar's global role. Before delving deeper into Adrian interview and insights, it's worth pausing to appreciate the broader shift taking place, one where monetary power is being quietly rebalanced, and gold is once again emerging as a strategic hedge in uncertain times.
I don't think I've got to choose my words carefully, because I don't think the situation in Ukraine or in the Middle East is a huge driver in gold, frankly. And so it's obviously a positive for gold as opposed to a negative for gold, but I don't think it's a huge driver. And so reversing those two situations, which I think we all hope and pray will happen, I don't think that will be devastating for gold. It might be, peace in Ukraine, for example, might be the trigger that causes an otherwise overvalued gold market to correct. But I don't think in and of itself it's a meaningful factor in driving the gold price. Again, if you look at central banks, for example, if you go back to the beginning of this century, global central banks had about 75% of their foreign reserves in the US dollar. And that's slowly come down over the last quarter century. 5 years ago, I think it was at around 65, 68%. It's now at 58%, last numbers I saw. So the trend has continued and accelerated. How long will that trend continue for? I don't know. Maybe just when they get to 50%, that will be enough. But if you're concerned about the US fiscal situation and you're concerned about dollar weaponization, I would have thought you want to just continue reducing that allocation to the dollar. So the urgency is less today than it was 3 years ago, and at 50%, the urgency will be less. But I think that trend is just going to continue, frankly. Nothing that's happened in the US this year would make foreign central banks say, we don't need to get out of the dollar anymore. Everything's fine. I think in the near term, the most likely thing that will cause gold to decline, by near term, I mean the next 3-6 months, the thing that will cause gold to decline meaningfully over an extended period will be a confluence of several factors. Ukraine war ends, Middle East war or Gaza war ends, probably because there's no more Gaza, but the Gaza war ends, a China deal, and then a series of trade deals with EU and other places. Just a confluence of factors that makes people feel they don't really need gold anymore. That's the most likely thing. But on the opposite side of that, just a continuation of what we've seen certainly will continue to drive gold. And the thing we haven't talked about yet, which is the most important thing coming up over the next 6 months, is the looming funding crisis for the federal government, the US federal government. Because that's something that's known about. It's been known about for a while. But this year, the US federal government has issued no new debt. The only debt issuance we've had this year, all year so far, is matching the maturities, the debt that's rolled off. So they haven't increased at all this year, which is really astonishing. And the longer that goes on, of course, that's why Trump is so desperate to get the debt ceiling raised. That's a different issue, but he's so desperate to get the debt ceiling raised so that they can actually issue new bonds, increase the amount of bonds issued. Because the longer it goes on, then of course the more has to be issued in a shorter period of time, which makes a successful sale or auction even less likely than if you can spread it over a whole year. And so it looks like a lot of the extraordinary measures that the government is taking, and there's been several of them. Even the deal with Wells Fargo Bank saying all your sins from 2008 are forgiven. I have to believe that part of that deal was, would you mind buying a few more treasuries for us? And that's on the small end, that's 50 billion or something. But all of the tricks and all of the tricks and techniques that every government uses, but they're all running out. And the government Besant has said, analysts have said that basically by the end of summer, the Fed will be the Treasury will be in a situation without the debt ceiling being raised where the US starts to run out of money. The debt ceiling will probably be raised. That's a whole different issue. We don't want to, that's a whole different issue. But even once they raise the debt ceiling, then the issue is who's going to buy the bonds at what price? I don't know about you, but I wouldn't lend the US government money 30 years at 4%.
Market strategist Adrian highlights a troubling trend in U.S. economic policy, a deliberate weakening of the dollar under the guise of boosting exports. While a softer dollar can support trade balances in the short term, it comes at the cost of long-term financial stability. One of the key concerns, Day notes, is that a depreciating currency discourages passive foreign capital inflows, both into U.S. bonds and equity markets. In his view, the current administration appears increasingly unconcerned with maintaining America's appeal to global investors. This shift in sentiment is most evident in the U.S. Treasury market. Foreign participation has been steadily declining for years. At the end of last year, overseas holders owned just 31% of the $28.55 trillion in outstanding U.S. Treasury debt. That's a dramatic fall from nearly 60% back in 2008 during the peak of the global financial crisis. The trend is even more pronounced in the T-bill market, where foreign ownership dipped below 20% in December, one of the lowest readings on record, and a sharp decline from around 50% just 10 years ago. Day links this erosion of foreign interest to broader concerns about the U.S. fiscal outlook and the reliability of its policy direction. While the economy has so far avoided a recession, he attributes this resilience to strong corporate balance sheets rather than robust fundamentals. Under the surface, stress is building. Rising credit card debt and growing default rates reflect a consumer under pressure, even as headline job numbers are propped up by government hiring and part-time roles. Let's get back to the interview.
And there was a lot of thought among the Trump team when he came in that they wanted to get a recession out of the way quickly, well before the midterm elections, which is what governments often do. Remember Reagan back in 1980, famously, had a recession immediately, and the economy was able to recover before the midterms. But I think, on the part of any government, it's always a tough thing to say, well, let's engineer a recession, or let's push the economy into recession as quickly as we can. That's always a difficult thing for even if it's the right thing to do, it's a difficult thing for a government to do. But I think at this point, frankly, we're 6 months in, 5 months in, but more importantly than 5 months, we've had these very, very dramatic policies from Trump. So I have to say at this point, certainly in the media and the public mind, he would own the recession at this point.
No, it makes a lot of sense. But we've seen the US dollar tank, for example. People have said, well, that is deliberate, because we've been talking about the US budget deficits and the trade deficits in particular. And with a weaker US dollar, it might be cheaper for the US to sell goods abroad and really bring the export side maybe up in the equation as well. So the term deliberate, and you sort of used it indirectly as well, that there is a certain deliberateness about pushing the US on at least to the brink of a recession here, if I'm interpreting correctly.
Push it to the brink, but you're right. I mean, the policies that they are outlining are driving the dollar down. Some of them deliberately, and some of them that's just the effect of the policies. And for Besant, yes, for Scott Besant, the Treasury Secretary, to say the U.S. has a strong dollar policy. Well, all I can say is, if this is a strong dollar policy, I hate to see what a weak dollar policy looks like. And the dollar's really interesting, or the policy around dollar is really interesting, because we're, as you pointed out, some of the benefits of a lower dollar. But with all of these things, there's always winners and losers, right? There's effects that are positive and there's effects that are negative. That's true, of inflation or higher interest rates. There's people who win by higher interest rates and there's people who lose by higher interest rates. Similarly with the dollar, in trying to push the dollar down and make the trade balance look better, the trade balance, because we're not really talking about services here, where the US has a huge advantage that offsets a lot of the trade deficit. But anyway, it makes the trade balance look better. But it also, I would think, makes foreigners less likely to want to buy US bonds in particular, but also US stocks. Now, of course, we know that if you're a foreigner looking at the US market and the dollar is weak, then you are buying US assets at a lower price. So that's a positive. But if the dollar is declining and you think it's going to continue to decline, that is definitely a big negative for foreigners wanting to buy US assets. And the US has kind of, I think, this administration has kind of said to foreign investors, we don't really care if you come here or not. And passive investments, not active, foreign companies building factories here. That's all welcome. But in terms of foreigners buying US equities, buying US assets passively, the US has sort of not gone out of its way to welcome foreign investment. And that, of course, is a huge stumbling block for
Gold has long been regarded as a prudent investment for those seeking to diversify their portfolios, hedge against inflation, and safeguard their wealth during periods of economic instability. Based on Adrian Day's insights, do you think gold's upward momentum is unstoppable? Or could a resurgence in confidence around the US dollar and financial markets shift the tide? Share your perspective in the comments below. If you found this video helpful, make sure to like, subscribe, and enable notifications so you never miss an update. Thanks for watching. See you in the next one.